Hello traders, welcome back to the Forex gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the Hikkake Candlestick pattern, a powerful yet often overlooked setup that can help you identify false breakouts and capitalize on the market reversal. This pattern is all about spotting traps in the market and using them to your advantage. So stick around until the end of this video so that we'll cover everything that you need to know, from understanding how this pattern works to how you can trade them effectively in both the bullish and bearish market. So let's get started. Now we start by understanding what this pattern is about. The Hikkake Candlestick pattern is a technical setup that helps traders identify false breakouts and potential reversals in the market. The word Hikkake simply translates to trap, which perfectly describes how this pattern works. It traps traders on the wrong side of the market before reversing sharply in the opposite direction. Now let's see the key components on the Hikkake candlestick pattern. We look at the bearish setup and the bullish setup. We start by noticing that there is an inside bar formation. This pattern begins with an inside bar where a candlestick has a small range. This bearish candle is the small range candle that is completely engulfed in the previous candle, meaning this red candle was completely engulfed in this bullish candle, creating an inside bar pattern. This signals temporary consolidation or indecisiveness in the market. After this, we enter a stage of false breakout. A breakout occurs where price moves beyond the high. In case of a bearish situation, when price moves towards the high, buyers in the market will say, oh, the price is about to go to the upside, and they will decide to buy at this area, whereby price comes back and close below, making them to take a loss or making them to be trapped at the wrong direction of the market. In case of a bullish setup, we see price pretend as if it's going to the downside. People start selling the market, and it quickly reverse on them and turn to the bulls area. This is basically what the false breakout means. The third key step is the reverse mode. After trapping the breakout traders that are willing to take the breakout of this inside bar, price quickly reverse or the opposite direction, triggering their stop loss and creating momentum for a sustained move. Now, why this pattern works is because it takes advantage of the common traders' behavior. Many traders react to breakouts from consolidation zones, but when this breakout fails, they are forced to exit their position. This creates additional momentum for the reversal, which experienced traders like you and I are going to learn how to capitalize from it. Now let's see how we can implement this into our trading strategy. Let's see where we can implement and how we can implement this into our trading strategy. We start by offering a structural way to trade the false breakout and the market reversal. To trade it effectively, you need a clear entry method, proper stop loss placement, and a solid risk management plan. So let's break it down step by step so that we can actually know how we can take this. The entry method is: first, you enter the trade when price breaks back above. When price breaks above in a bullish scenario, when price breaks above, and in a bearish scenario, when price breaks below. From this setup, let's first understand the bullish setup. I can see price came to a support region after breaking the previous resistance, and as you can see, this is a strong area of resistance. Price decided to break and form our inside bar pattern. You can see this bearish candle is completely engulfed by the previous bullish candle. Then price showed that sellers were returning to the market before it quickly reversed, and this would have a lot of traders that would want to catch the pullback phase of this setup. So remember, we are going to take our trade the moment price breaks above and close. This confirms that the false breakout has reversed and momentum is shifting in your favor. So the moment we see price breaks, fakes out and close, we will decide to enter a long position. This is where we enter our long position. We can set a limit order in case of any pullback. Alternatively, you can wait for pullbacks after the reversal occurs. You can wait for price to pull back after the reversal occurs. You can place a limit order near the high or low of the inside bar to get a better entry. You can place it if in case you want to play the pullback. You can decide to place your entry at this area. When price comes back to retest the inside bar, this is where you can decide to enter your trade. If you want to use a limit order, you can also decide to enter the moment you see the candle close, but to be more conservative, you can enter exactly when price comes to retest that region. Where do we drop our stop loss? We keep our stop loss orders slightly below the reversal candle to ensure that if price gains strength to be sure that price when price gets to this area, it will invalidate our trading setup. Now this is the case for a bullish setup. Now let's see where we can put our take profit. Remember, we have to manage our risks effectively by always using a stop loss. But for our take profit, we have to set our take profit at key support areas. We can look for key support areas, previous support areas on the chart. We can look for previous support areas on the chart, or we can just aim for a risk to reward of minimum 1:2. We can aim for 1:2 to be more safe, to be on the safe side. You aim for 1:2 as the case may be. Now if we entered from this region, the moment price reversed on us and broke above our inside bar candle, if we entered from this candle, it would have been a good trade at the same time. But it's always good to wait for a retest. But you can also enter using this principle, because it's not every time price would decide to come back to retest. So at any point in time, you just need to set a few rules that you would have to follow when taking the trade. Now let's see a bearish setup. And in case of a bearish setup, we'll first of all spot our inside bar candle. And as we can see our inside bar candle. This bullish candle was totally engulfed by this bearish candle. After we saw the total engulf of this candle, we can see that price deceived buyers. At one point in the market, price showed this candle was in a bullish scenario, so it will trap all those traders that wanted to enter long in this area. When it traps all those traders that wants to buy long because price broke above the inside bar, they will set their stop loss just below, and price will quickly reverse on them, closing below that point. So this is the basic principle for this pattern, trapping those traders before reversing in the intended direction. And when price reverse, we can wait for price to pull back, or we can take the trade exactly from that area, put our stop loss below, and we aim for 1:2, 1:3 as the case may be. So this is how we can enter the trades on both the bullish and bearish scenario. Now let's not forget that when we are taking this trade, we have to ensure that for a bullish setup, we take this trade from a support region. It has to be a strong support or a previous resistance area that turns support to further validate our setup. You can always take profit at a previous resistance level, or in case of a bearish trade, you can take it at a previous support level. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching and I will see you in the next video.